America's national debt has quietly surged past $36 trillion, dollars, a figure larger than the entire U.S. economy. Yet few grasp how deeply it affects their daily lives. From the interest on your mortgage to the future of your Social Security, this isn't just a government problem. It's your problem too. For decades, debt was a tool used to manage emergencies like wars, recessions, stimulus packages. But now, debt has become the emergency. It's no longer a response to crisis, it's the fuel for one. This story isn't just about numbers, rather, it's about consequences, about how a mountain of debt built on decades of delay is starting to shift beneath our feet. It's about interest costs that threaten to swallow the budget, allies and investors beginning to lose confidence, and a political system too divided to pull the brakes. This didn't happen from one bad decision or one crisis. It's the result of decades of habits, spending more than the country earns and borrowing to cover the gap. It's like living on a credit card for 40 years without ever fully paying it off. Before 1980, the U.S. debt was large but manageable, around 30% of GDP. But things changed during the Reagan administration. The government sharply increased military spending and cut taxes at the same time, believing that economic growth would cover the cost. It didn't. The national debt tripled in that decade. By 1990, it had crossed $3 trillion, dollars, and the debt-to-GDP ratio had climbed toward 50%. The next major leap happened under President George W. Bush. After September 11th, the U.S. launched two expensive wars in Iraq and Afghanistan. At the same time, it passed massive tax cuts, reducing federal revenue while military and security spending soared. From 2001 to 2008, the debt nearly doubled, from $5.7 trillion dollars to $10 trillion. Dollars. Then came the Great Recession in 2008, where banks collapsed and housing markets crashed. The federal government had to rescue financial institutions and stimulate the economy with bailouts and public spending. This added another $1.4 trillion dollars in stimulus spending and caused massive revenue losses. By 2012, the debt had climbed past $16 trillion. Dollars. The single largest shock came during COVID-19. To prevent a complete collapse of the economy, the government passed multiple relief bills: unemployment checks, business bailouts, stimulus payments. In total, over $5 trillion dollars was injected into the economy through borrowed money. In just 2 years, and from 2020 to 2022, the national debt jumped from $23 trillion dollars to over $30 trillion. Dollars. That's the fastest debt expansion in U.S. history. But you'd expect that once the emergencies ended, the government would slow down borrowing. But it didn't. Even in 2023, when the economy was relatively stable, the federal government ran a $1.7 trillion deficit. That means the government borrowed $1.7 trillion just to cover its regular expenses. Not for a war, not for a crisis, just everyday operations. So, what's driving this massive shortfall? It comes down to three key factors. First, spending keeps growing. Programs like Social Security, Medicare, Medicaid, and interest on the debt eat up a huge part of the budget. As the population ages, costs go up, and especially healthcare and pensions. Secondly, tax revenue isn't growing fast enough. The U.S. has had major tax cuts over the years, you know what in 2001, 2003, and 2017. These cuts reduced the government's income while spending kept rising. And thirdly, there is no political will to fix it. Neither party wants to raise taxes or cut spending. Doing either is politically risky. So year after year, they kick the can down the road, borrowing instead of balancing. But even before a full-blown crisis arrives, Americans are already feeling the effects of this unsustainable path through what economists call the hidden inflation tax. As the government borrows more and the central bank accommodates with loose monetary policy, inflation rises. It might not show up as a line item on your tax return, but it quietly eats away at your paycheck, your savings, and your future. Between 2021 and 2023, U.S. households lost significant purchasing power as inflation surged past 9% at its peak, wiping out wage gains and eroding fixed incomes. For the middle class and retirees, it felt like falling behind in a race they didn't even know they were running. On the surface, America still looks stable. The stock market is high, the dollar remains strong, and the world keeps buying U.S. bonds. But beneath that calm is a growing storm. A tipping point is coming, not because the debt exists, but because faith in America's ability to manage it could erode. And when trust fades, markets don't wait. They react fast. And one of the first places that reaction shows up is in the bond market. When countries borrow money, they issue bonds. Investors buy those bonds with the expectation that they'll be paid back with interest. If they believe the country is financially sound, they accept low interest rates. But when that confidence weakens, even slightly, they demand higher returns to compensate for risk. That's exactly what's happening now. Back in 2020, the interest rate on a 10-year U.S. Treasury bond was just 0.6%. Fast forward to 2024, and that figure has jumped to over 4.3%. That's a staggering seven-fold increase in only a few years. This shift isn't just a market quirk. It has enormous consequences. As rates rise, the government's debt servicing costs balloon. In 2023 alone, the U.S. spent $870 billion on interest payments. It's more than the entire federal education budget. More than what the U.S. spends on housing, roads, or scientific research combined. If this trajectory continues, interest payments could soon become the single largest federal expense, surpassing Medicare and even Social Security. And with each additional borrowing spree, the cycle accelerates. More debt, higher interest costs, less room to spend on anything else. Adding to this pressure is America's slipping credit reputation. In 2011, Standard & Poor's downgraded the U.S. credit rating for the first time in history, citing political deadlock over the debt ceiling. In 2023, Fitch followed suit. These downgrades might seem symbolic, but their impact is real. They increase borrowing costs, rattle investors, and can trigger panic across global markets. If Moody's, the last of the big three agencies, joins them, it could deal a serious blow to investor confidence. All of this chips away at something even more critical than ratings: global trust. The U.S. dollar is the world's reserve currency. Central banks around the world hold trillions in U.S. treasuries. But this system runs on faith, the belief that the U.S. is stable, responsible, and will always pay its debts. If that trust erodes even gradually, the consequences ripple outward. A slow pullback from the dollar could push its value down, fuel inflation, and drive interest rates even higher. Financial markets would grow more volatile, not from a sudden crash, but from the steady leaking of confidence, like cracks widening in a dam. Meanwhile, as Washington continues borrowing at record levels, it's not just adding to the debt. It's competing with private businesses for the same pool of capital. Economists call this crowding out. When the government absorbs more investment dollars, less is available for everyone else. That pushes up interest rates across the board, making mortgages more expensive for families, student loans heavier for graduates, and startup capital harder to access for entrepreneurs. Over time, this quietly erodes the foundations of economic growth, stifling innovation, productivity, and long-term prosperity. So far, financial markets have stayed relatively calm, but history reminds us how quickly that calm can snap. In 2010, Greece appeared manageable until a sudden loss of investor confidence triggered a debt crisis that rippled across the Eurozone. Now, the U.S. is not Greece. It has a more resilient economy and the privilege of printing its own currency. But that doesn't make it immune. Even a hint of default, perhaps from another political showdown over the debt ceiling, could rattle global markets and shatter assumptions about American reliability. Because at its core, the real danger isn't just about how big the debt is. It's about trust. Trust that the U.S. will honor its obligations, manage its finances, and maintain economic stability. Once that trust begins to erode, numbers on a spreadsheet turn into global consequences. And those consequences don't stay within U.S. borders. That's because the U.S. dollar serves as the world's primary reserve currency. Roughly 60% of all global foreign exchange reserves are held in dollars, and more than half of international trade is invoiced in it. Central banks around the world hold U.S. Treasury bonds not just for returns, but for safety. Over $7.6 trillion of America's federal debt is owned by foreign investors, with Japan and China leading the pack. This gives the United States what economists call an exorbitant privilege, the unique ability to borrow cheaply in its own currency and avoid the debt risks most other nations face. But that privilege depends entirely on confidence. Confidence in America's political and economic system. That confidence, however, is no longer guaranteed. Already we're seeing early signals that the world is adjusting. Countries like China and Russia have been actively working to reduce their reliance on the dollar, a process known as de-dollarization. They're signing trade deals in yuan, euros, or local currencies, and steadily trimming their holdings of U.S. treasuries. In fact, China's U.S. debt holdings have dropped by nearly 40% from their peak in 2013. Meanwhile, the BRICS nations, Brazil, Russia, India, China, and South Africa, have openly discussed alternative reserve systems and payment mechanisms to reduce dollar dominance in trade and finance. These moves, once symbolic, are gaining momentum. The U.S. share of global GDP has already declined from around 40% after World War II to about 24% today. At the same time, emerging economies are growing their economic footprint and demanding a greater voice in global finance. If enough of them start to hedge against the dollar by holding fewer U.S. assets or settling more trade in other currencies, it could gradually chip away at America's borrowing advantage. This isn't just an economic issue, there's a strategic cost too. The dollar's global dominance gives Washington powerful tools. The ability to impose sanctions, control capital flows, and influence global lending rules. But overusing those tools, especially financial sanctions, has encouraged targeted countries to build parallel systems. If the dollar's central role weakens, so too does America's geopolitical leverage. In short, America's mounting debt isn't just a domestic headache, it's a slow, silent threat to its position as the cornerstone of the global financial system. Left unchecked, it risks undermining not only economic stability at home, but also the global influence that has underpinned U.S. leadership for decades. But while the risks are mounting, solutions remain politically elusive. Fixing America's debt crisis would require hard choices, either raising taxes, cutting spending, or both. But those decisions are politically toxic. Social Security, Medicare, and defense consume most of the budget, yet remain untouchable in public debate. Meanwhile, tax increases are met with fierce resistance from both voters and politicians. Even when the alarm bells ring, the response is more political theater than fiscal action. Debates become standoffs, deadlines turn into drama, and urgent problems are buried under partisan gridlock, until the next crisis forces a rushed, imperfect fix. The longer this continues, the narrower the path becomes to avoid a reckoning, not just economically, but in the credibility of the system itself.